The forced liquidation cascade, how margin calls transform leverage positions from calculated bets into automatic wealth destruction engines, creating self-reinforcing sell spirals that devastate portfolios in hours, not days. March 2020, collapsed 34% in 33 days, the fastest bear market in recorded history, faster than 1929, faster than 2008. But here's what almost nobody talks about. Thousands of traders who correctly identified the eventual recovery, who knew the market would bounce, lost everything anyway. Not because they were wrong about the direction, because they ran out of time to be right. They were using leverage. And when the margin calls came, their brokers didn't wait for opinions. They liquidated. Automatically. Ruthlessly. At the absolute worst prices, you can be right about a trade and still be wiped out before the trade pays off. That is not a paradox. That is the mechanical reality of leveraged investing, and most retail traders never understand it until it's too late. Let me give you a number that should stop you cold. According to data from the Financial Industry Regulatory Authority, FINRA, margin debt in U.S. brokerage accounts peaked at $935 billion in October 2021. By June 2022, it had collapsed to roughly $600 billion. That's $335 billion in forced deleveraging in less than 8 months. Not voluntary selling, forced selling. Margin calls being executed across millions of accounts while the market was already falling, which made the market fall further, which triggered more margin calls. This is the core paradox of leverage. The very mechanism designed to amplify your gains becomes the automated system that guarantees your ruin the moment conditions move against you. The cruelest part. The margin call doesn't care that you were almost right. It doesn't care that the stock recovered 3 weeks later. It doesn't care about your thesis, your research, your conviction. It executes. And then it sends you a statement. If you have ever used a margin account, or if you are thinking about using one, what follows is the most important financial education you will receive this year. Because understanding margin call mechanics is not optional knowledge for leveraged traders. It is survival knowledge. Let's build this from the foundation, because the terminology here is not just academic. Every single term maps directly to a real dollar amount in your account. Margin and initial margin requirement. When you open a leverage position, your broker extends you credit. You put up a percentage of the full position value. This is your initial margin. Under Regulation T in the United States, brokers require at minimum 50% initial margin for equity purchases. That means to control 100,000 worth of stock, you need 50,000 of your own capital. But this is where retail traders make their first critical error. They think of margin as borrowing money to buy more stock. That framing is dangerous. The more accurate framing is this: margin is a contract that gives your broker the legal right to liquidate your assets without your permission if your account value falls below a specified threshold. Read that sentence again. Without your permission. Maintenance margin and the trigger threshold. After your position is open, the broker imposes a maintenance margin requirement, typically 25% for standard accounts, though many brokers set this higher at 30% or 35%. This is the minimum equity you must maintain as a percentage of the total market value of your positions. Here's the math that destroys accounts. You buy $100,000 of stock using a $50,000 of your own money and a $50,000 borrowed on margin. Now the stock drops 30%. Your position is now worth $70,000. But you still owe the broker $50,000. Your equity is now only $20,000, which is 28.5% of $70,000. If your broker's maintenance requirement is 30%, you've just breached the threshold. The margin call is issued. And here is the mechanic that most tutorials gloss over. You do not get to choose which assets are sold. The broker has the right to liquidate whatever positions they deem necessary, often the most liquid ones, to restore the margin ratio. They may sell your best performing positions to cover losses in your worst ones. They may sell at the opening price the next morning. regardless of whether that is a rational price. The leverage multiplier and drawdown asymmetry. This is the concept that changes how you think about risk permanently. Leverage amplifies returns in both directions. But the mathematics of loss recovery creates a brutal asymmetry. If you lose 50%, you need 100% gain just to break even. If a 2x leverage position loses 50% of the underlying asset, your entire equity can be wiped to zero. But the deeper problem is volatility drag, sometimes called beta decay in leverage ETF discussions. Even if an asset ends the year flat, a leveraged position that experiences significant daily swings will still lose money over that period. The path matters, not just the destination. Nassim Nicholas Taleb, in his seminal work The Black Swan, framed this precisely. Markets have fat tails. Extreme events occur far more frequently than standard statistical models predict. Leverage transforms a fat tail event from a serious setback into an extinction-level event for your portfolio. The very nature of borrowed capital means your risk of ruin is not linear, it is exponential. This is the architecture of amplified risk. Every brick in that structure is designed to accelerate outcomes in both directions. And the broker's risk management system is always faster than your emotional response. Let's talk about what this actually costs, not in hypotheticals, but in documented, timestamp financial destruction. The Archegos Capital Collapse, March 2021. Bill Wong's family office, Archegos Capital Management, had built concentrated, highly leveraged positions in media and technology stocks, including Viacom CBS Discovery, several Chinese ADRs, using total return swaps. These are derivatives that provide leveraged exposure without appearing as direct stock ownership on public disclosures. At peak, Archegos controlled positions estimated at $100 billion in notional exposure against a relatively modest equity base. When Viacom CBS announced a stock offering in late March 2021 and shares began to slide, the margin calls came. But because Archegos had the same leverage positions spread across multiple prime brokers, Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, those brokers began racing to liquidate first. In a single week, over $30 billion in market value was erased from those stocks. Credit Suisse lost approximately $5.5 billion. Nomura lost roughly $2.9 billion. Two major global banks, not retail traders, but sophisticated institutional prime brokers, suffered catastrophic losses from a single client's margin call cascade. If it can happen at that scale, with that sophistication, in that time frame, what does it mean for an individual account? Warren Buffett put it plainly in his 2017 Berkshire Hathaway letter, "Leverage is seductive, but it can wipe out a smart person fast. There is simply no telling how far stocks can fall in a short period. The invisible financial loss here is not just the dollars erased. It is the opportunity cost, the compounding years your capital would have earned if it hadn't been forcibly liquidated at a market bottom." A 50 Zalozan account wiped in a margin call in March 2020 and never recovered missed the subsequent 100% rally in the S&P 500 over the following 12 months. The real loss wasn't 50,000, it was 100,000, and every year of compounding beyond that. The fear mechanism embedded in leverage is specifically the fear of missing out, FOMO. Traders use leverage precisely because they want more exposure to an asset they already believe in. This is rational confidence distorted into irrational position sizing. The belief in the trade is sound. The capital structure behind it is catastrophic. And this distortion is everywhere. It shows up in crypto traders using 10x leverage on Bitcoin. It shows up in retail investors buying call options on tech stocks with borrowed money. It shows up in homeowners who treat their mortgage, leverage property as a guaranteed wealth machine until rates rise and refinancing becomes impossible. The margin call mechanic is simply the most honest version of what leverage always does. It reveals the true cost of capital at exactly the moment you can least afford to pay it. Let's bring this into real portfolio territory. because the systemic picture only matters if you can see it at the account level. If you held a 2x leveraged tech ETF, something like TQQQ, from November 2021 through June 2022, here is what happened to your net worth. The Nasdaq Composite fell approximately 33% over that period. A 2x leveraged instrument tracking that index declined roughly 71%. The 1,000 position became approximately 29,000. And that assumes you were never margin called and never forced to sell, that you simply held through the drawdown voluntarily. Most leveraged traders did not have that luxury. Investors who used margin to buy crypto in November 2021 experienced complete account wipeouts within 6 months. Quote from roughly 69,000 under 18,000 by June 2022, a 74% decline. At 3x leverage, that's a 222% notional loss against your equity, meaning accounts were not just zeroed, they went negative in some cases, leaving traders owing money to their exchanges. Now let's map the 6 consequence dimensions. Portfolio impact. Drawdown magnitude under leverage is not additive. It is multiplicative. A 25% decline in an underlying asset with 3x leverage does not produce a 75% drawdown. It produces a complete equity wipeout because the maintenance margin breach triggers forced liquidation before 75% is even reached. Correlation between assets also tends to collapse toward 1.0 during market crisis, meaning your diversified, leveraged portfolio all falls simultaneously, removing the very buffer you thought you had. Career and income impact. The 2020 crypto collapse led to over 25,000 layoffs across major crypto firms: Coinbase, Celsius, BlockFi, Voyager. Many of these firms were themselves operating with leverage or had lent heavily to leveraged players. When the margin calls hit the ecosystem, the employment in that ecosystem followed. Celsius Network, which had offered yield products funded by leveraged lending, filed for bankruptcy in July 2022 with a $1.2 billion hole in its balance sheet. Hundreds of thousands of retail depositors are still waiting for recovery years later. Savings and wealth. The insidious dimension of leverage is that it attacks your base capital, the money that was supposed to be working safely for your future. A trader who allocated 30% of their savings to a leveraged position and lost it all hasn't lost 30% of their wealth. They've permanently damaged the compounding engine of their financial life. 30 years of compounding on that lost capital is gone. Behavioral finance. The margin call creates a specific behavioral trap that Ray Dalio has described as the debt cycle feedback loop. When positions are falling and margin calls loom, the natural human response is to hold, to believe the thesis will be vindicated. This creates an action precisely when action is most required. Then, when the forced liquidation occurs, the emotional shock produces the opposite extreme permanent risk aversion, complete withdrawal from markets, and missing the recovery that follows. Risk perception. Overconfidence bias is epidemic in leveraged trading. Studies from behavioral economists show that retail traders systematically overestimate their ability to predict short-term price movements and underestimate tail risk. The anchoring heuristic, comparing today's price to a recent high, leads traders to see a 20% decline as a buying opportunity, without accounting for the possibility of a further 40% decline before recovery. Systemic blind spots. The most dangerous blind spot in leveraged investing is counterparty risk. When you hold a leveraged position through a broker or exchange, you are trusting that the counterparty remains solvent. FTX collapse in November 2022 demonstrated that even a $32 billion exchange could become insolvent in 72 hours. Clients with leveraged positions didn't just face margin calls. They faced a frozen platform, locked assets, and a bankruptcy proceeding that would take years to resolve. The unlearning process begins the moment you stop asking better and start asking, does this level of leverage belong in my capital structure at all? That cognitive shift from seeking better tactics within a dangerous framework to questioning the framework itself is a begin confronting the framework itself. Understanding how margin calls work is not enough. You need a structural response, a set of non-negotiable practices that protect your capital before the volatility event, not after. Portfolio rebalancing and uncorrelated asset allocation. Before deploying any leverage, audit your total portfolio for true diversification, not just across sectors, but across asset classes with genuine low correlation. Traditional 60-40 portfolios, 60% equities, 40% bonds, failed because rising interest rates caused both to decline simultaneously. Real uncorrelated assets include commodities, real assets, volatility strategies, and short-duration instruments. No leverage position should represent more than 5 to 10% of your total net worth, not your investable assets, your total net worth. Volatility hedging, structuring the hedge before you need it. Options, inverse ETFs, and gold allocations are not bear market trades. They are insurance premiums that you pay during calm markets to protect against storm damage. A simple 5% allocation to long, dated put options on your primary equity exposure can dramatically limit drawdown without meaningfully reducing expected returns over a full cycle. The key is purchasing this protection when volatility is low, when the VIX is under 15, not when it spikes above 30 and the cost has tripled. The 3-bucket liquidity reserve system. Bucket 1, 6-12 months of living expenses in cash or money market instruments. Completely untouchable, never leveraged. Bucket 2, medium-term capital in unleveraged, diversified positions with a 3-5 year horizon. Bucket 3, risk capital, the only bucket from which any leveraged or speculative exposure is drawn. If a margin call in bucket 3 wipes it entirely, your financial life continues. That structural firewall is not optional. It is the difference between a setback and a catastrophe. Stress testing against historical crash scenarios. Before entering any leveraged position, run it through 3 historical stress tests. Crisis, S&P down 7%, the 2020 COVID crash, S&P down 34% in 33 days, and the 2022 rate shock, S&P down 25%, bonds down 18% simultaneously. Ask one question for each scenario: does my account survive this? Or does the maintenance margin breach trigger liquidation before the recovery? If the answer is doesn't survive, your position size is too large. This is not pessimism. This is the structural discipline that separates traders who last decades from those who last months. George Soros, who built one of the most successful leveraged trading records in history, made this observation: it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. That asymmetry is everything. Leverage destroys it. Discipline restores it. The margin call is not a market anomaly. It is not bad luck. It is a contractual, mechanical outcome that is mathematically guaranteed to occur if you hold leverage positions long enough without proper risk architecture. The traders who understand this do not avoid leverage out of fear. They deploy it surgically within a structure that ensures their survival at any point in the market cycle. The goal is not to predict the market. It is to be prepared for every outcome it delivers. If this analysis shifted how you think about leverage and risk, if it made something click that wasn't clicking before, then you already understand why this channel exists. Every week, this is what we do. We go deep into the mechanics that determine whether your financial decisions build wealth or destroy it. Subscribe so you never miss an analysis. And if you know someone who is trading on margin right now without understanding what you just learned, send them this video. It may be the most valuable thing they watch this year.